Hi, my name's Andy Headley. I am the manager of the Nedgroup Investment Global Equity Fund, and I'd like to give everybody an update for the fourth quarter performance of 2023 and 2023 as a whole. So just looking at performance, which this slide shows, as you can see from the white column for the MSCI World, 2023 was a very strong year for the performance of equity markets, with the MSCI World appreciating 23.8%, which I would say was very unexpected at the start of the year by most participants, simply because inflation was high and people anticipated that rising rates during 2023 would lead to a weaker stock market performance. But I think what happened perhaps from sort of September, October onwards was that markets expected inflation to fall rapidly and therefore are beginning to price in the US Federal Reserve in particular, but central banks reducing rates and that having a positive impact on valuations and therefore share prices. So within this context, the Nedgroup Investments Fund, Global Equity Fund, appreciated 21%, as can be seen on the left-hand side, slightly below the index. We tend to perform slightly worse than markets when they appreciate very, very rapidly, as we've seen here. But we'll come to the discussion for the full year and some attribution. For the 3-month period, as you can see, we delivered similarly 9% for the 3 months versus 11.4% for the MSCI World. We obviously manage the fund, as most people know, looking at absolute returns. So we're trying to deliver absolute returns for clients. And that's on an annual basis, which is probably too short really for us to assess ourselves against, but on an annual basis, our target of CPI plus 6 delivered 9% again versus the 21. But over the longer term, as you can see, since inception, CPI plus 6, which is our target to exceed, has been 8.4% annually, with the fund returning 9.1. So just to look at some attribution, I realize this is a very busy slide. The most important column is the far right-hand total effect, to see how we performed in certain companies that we hold and also in certain sectors. And there's a few things to draw out from here and from the 12-month version, which comes after this. Very briefly, it's just the two impacts I'd like to draw out are healthcare, which on here, as you can see, is a 80 basis point, 0.8% negative, and information technology, which is a minus 1.1% negative for the fund. Equally in communication services, we happen to have a difficult 3-month period with Charter. But if we look at the 12-month period, as you can see, communication services were actually very positive, with a positive 2% at the top there, largely driven by Alphabet, but Charter was much better over the 12-month period. And again, two factors I wanted to draw out from this attribution analysis are the healthcare, which has cost us 4.8 percentage points during 2023, and the IT position, which has cost us 4.7 percentage points. So both of those two sectors have been very costly for us over the year of 2023. And outside of those sectors, obviously our performance was very good, because those two sectors between them dragged down over 9 percentage points of performance. And so just to discuss those two a little bit, healthcare is very interesting. We are very excited about the prospects for healthcare, and particularly life sciences, over the coming 5 to 10 years. It's obviously a very large weight in the fund. As you can see here, the average weight is 25% of the fund, whereas it's only 13% of the index. So we are very overweight. Now, during 2023, we've had a couple of negative impacts on the sector as a whole. The sector is suffering what we would call a bullwhip effect from COVID, where during COVID, there was obviously elevated demand for a lot of healthcare equipment, life sciences equipment, PCR testing for COVID. And because of that high demand, inventory cycles grew longer. So people had to order earlier because there wasn't enough inventory, so they over-ordered. And now what we're seeing is the other side of that bullwhip effect, where because people have over-ordered, they now have too much stock, and they are reducing orders significantly because they're holding too much inventory themselves, and that's leading to lower orders for our healthcare positions. And so there is a very temporary, as we see it, inventory cycle occurring in the healthcare sector, which has led to lower revenues than we would normally anticipate, and lower growth in revenues than we would normally anticipate, and therefore an impact on share prices. And the second factor we're seeing in healthcare is China. As you may know, China economically has been quite weak during 2023. On top of that general weakness, there has been an anti-corruption crackdown by the Chinese authorities, in particular on hospitals and hospital ordering. And a lot of our positions, so Becton Dickinson, Bio-Rad, Thermo Fisher, they sell into Chinese hospitals. And so because there's been a crackdown on corruption and corrupt practices, the hospitals have stopped ordering. They're too worried to order more equipment. And as a consequence, the companies that we own in the fund have seen a negative from fewer orders coming through from China. Again, we think that's temporary, but equally the China effect is now very small in the companies that we own. And so we feel like going forwards, the drag from China is very small, regardless of what happens in China. Just turning to technology, information technology has been once again by far and away the best performing sector during 2023, driven very much by the semiconductor stocks, and in particular those semiconductor stocks that are perceived by investors to be exposed to artificial intelligence, NVIDIA being the largest of those. As you can see, the return for investment for information technology during the year is a whopping 58% for the sector, and the sector represents 21% of the total index. We hold very little in technology, as you can see on the left-hand side here. We only own just over 4% on average, and our holdings actually delivered 63% return. But because we don't own very much in IT, obviously we were impacted because we just don't own the area of the market that has appreciated the most during the year. And the reason we don't own much in the way of information technology is that we are very long-term investors, and the nature of information technology is that they see rapid change. There's often change in leadership within technology, and we just don't have the visibility that we like to see over 5 to 10 years to invest in some of these companies, particularly given the valuations that these companies trade at. They trade at very high valuations, which basically assumes that they will continue to be dominant within their sectors for a long, long time. And it's something that we are very skeptical about. And so we have a small weighting in technology. You will all have heard that 2023, the big 7 tech companies delivered the bulk of the performance for the S&P 500 in the US, and we have very limited exposure to those. So obviously that's a drag relative to the market. So moving on to the portfolio at the end of December, this is a snapshot of the portfolio. As you can see, we have continued to have, I should say, a good exposure to transport and travel, which has been a theme of ours since the COVID pandemic, where we've seen a recovery in transport and travel with positions like Airbus, but also MasterCard, which benefits from cross-border travel, Vinci, which owns toll roads and airports. And so we have this quite large exposure. Aena is the Spanish monopoly airport operator to the continued recovery in air travel and transport. Outside of that, again, just to point out that IT remains a very small proportion of the portfolio at 3%. We held a larger position in Microsoft, which we sold some of during the year, simply due to valuation. The valuation of Microsoft is now very high. We think it is a wonderful company. We think it's quite well protected as an IT company. We think it has a lot of strategic advantages going forwards, but the valuation is now such where we think that the annualized rate of return we will earn in that position is a lot lower than previously. And again, healthcare, as you can see, 25%. Industrials is our largest sector weighting at 30% nearly, but it's very heterogeneous exposure. So we have things from Canadian Pacific, which is a class 1 railroad in the US, obviously through those travel and transport companies like Airbus, Safran, Aena. In terms of activity over the last 3 months, we made no purchases, made no sales. As people know, we're long-term investors. We tend to hold our positions for around 6 years on average. And so often in a single quarter, we may be not buying or selling anything completely. But obviously we will be trading the position sizes as things like Microsoft, the share price moves up, and we may take some weighting out of some companies as valuations rise. I just wanted to finish off this update by talking a little bit about the areas that we're excited by. Obviously, during 2023, we had almost a 5 percentage point drag from our healthcare positions. And we are not inclined to change our healthcare weighting at 25%. We think there is an awful lot of potential upside or latent upside in our healthcare holdings, which some of which didn't perform well during 2023. But we anticipate much better performance during 2024. And we think that they have very long-term drivers behind them. So I put a couple of slides together here on why we're so positive on the healthcare positions. So we see very long-term demand for the companies that we're exposed to. What we've seen is obviously mapping the genome, which will lead to a lot more drug development and diagnostic testing going forward. You've probably all read about cancer testing and oncology testing improving to DNA tests. And we think that will just continue to expand. We also think that healthcare is one of the low-hanging fruits for AI. So artificial intelligence will allow the faster development of drugs because they will be able to use AI to run through the thousands of potential drugs to treat a disease, particularly these larger drugs, so biologics and proteins. And so AI will really help in the development in drug discovery. So we think that there's a lot of potential upside as we come through this system and we come through with AI driving more and more drug development, particularly in these complicated drugs. And we're seeing that with an expanding pipeline of therapeutics coming through. So as we can see here, we've just put a couple of charts in on the cost of the human genome, which has declined substantially, which we think will drive diagnostics as well as drug development, and the pharmaceutical growth outlook, which, if you could read, given the size of the slide, just shows that biologic drugs, so these more complicated drugs, are growing extremely quickly, and we anticipate that will continue. The companies in the fund, we have a lot of exposure to this, include Illumina, which does genetic testing, so it's by far and away a market leader in the equipment for genetic testing. Biorad, which does PCR tests and bioprocessing. Thermo Fisher, which is a labs company, so supplies into labs around the world, the largest in the world. Bioprocessing again. Catalent, which does contract manufacturing, primarily for biologic drugs as well as some small molecule drugs. So this is just digging further into the AI benefit for drug companies. And as we can see, we are at a position now where the industry is starting to use artificial intelligence more and more to give them the first indications as to what proteins or what biologics will work in certain diseases. And as you can see on the bottom of this slide, I'd ignore the academia part. But for the industry, there are 34 companies that were surveyed, and around 12% of them were extensively using AI, and 26% substantially. But if you look at the biotechs, which is on the right-hand side of the graph, you can see that the biotech companies are significantly using AI in development of new drugs. And as we can see on the next slide, that this is leading to much faster and greater discoveries in biologic drugs. So the blue lines here are what we would call small molecule drugs. So they're relatively simple drugs. The red lines on this chart show the drugs that are approved by the FDA in the US that are biologics. So the red is biologics. And as you can see from sort of the early 2000s, when maybe 2 or 3 were approved each year, in the last 7 years, on average, 14 or 15 have been approved. And we think this will continue to expand as artificial intelligence allows much quicker narrowing down of prospects. So the FDA are increasingly approving these drugs, and they can be life-saving drugs with very high prices. On the right of this chart, you can see that the FDA have approved quite a large number of drugs during 2023, but the manufacturing capacity for these drugs is not around. So we own companies that have some of this capacity. It's very scarce. It's very difficult to do. It involves a lot of typically fermentation. which has to be exactly the same every time. So we have some exposure to both the growing number of molecules and this lack of capacity. Just to quickly touch on two of the companies that we own that we think have a lot of potential. Thermo Fisher Scientific, it's the largest provider of scientific instruments, consumables to labs around the world. It's a really wonderfully managed business. It has very strong long-term growth. The company talk about the industry they're in growing 4 to 6%, and they think they will grow 3 percentage points more than that in the medium term. So they think on average they will grow somewhere between 7 and 9% organically. They do tuck-in acquisitions. They've been very successful in expanding the areas that they work in to provide a full and seamless service to their lab customers. The second company that may be less well known is a company called Bio-Rad. So Bio-Rad has two things really for us. One is it owns a stake in a company called Sartorius, which is instrumental in producing biologics. So it does everything from helping in the discovery phase all the way through to preclinical and working out the best way to manufacture biologics, doing quality control of biologics in the early phase, and then actually doing the production of the biologics. So it's very exposed to life sciences and biologics, and we think that stake is undervalued within Bio-Rad. And then Bio-Rad itself is a very strong company in life sciences and clinical diagnostics. They're market leaders in a lot of areas, including things like droplet digital PCR, which is a new technology, which is particularly good in diagnostics and allows for more accurate diagnoses with much smaller amounts of sample. So it's a very well-positioned company for the next 5 to 10 years. So with that, I'd like to thank everybody for listening to the quarterly update.